Tonight, the crypto market isn't just moving numbers on a screen, it's testing belief, patience, and fear all at the same time. In the last 24 hours alone, more than $2.5 billion were wiped out in liquidations as Bitcoin violently swung, catching over-leveraged traders completely off guard. Screens went red, positions vanished in seconds, and once again the same question echoed across the world. Is this the end, or is this exactly what happens right before the next chapter begins? Bitcoin dropped hard, then tried to recover, hovering around key support levels while traders watched every candle like it could decide their future. This wasn't a random crash. It came from a mix of macro pressure, risk-off sentiment in global markets, and extreme leverage built up during recent rebounds. When the price snapped, the system did what it always does. It flushed out weak positions fast and without mercy. Fear spiked. Funding rates flipped. Liquidation heat maps exploded, and suddenly, the same people who were bullish days ago were questioning everything. Altcoins followed the chaos, but something interesting happened beneath the surface. Despite the panic, several major altcoins bounced from deeply oversold levels. Ethereum, along with other large-cap tokens, showed signs of buyers quietly stepping back in. Not loudly, not emotionally, but strategically. This kind of price action doesn't scream euphoria. It whispers accumulation. It suggests that while retail traders are shaken, someone else is watching patiently, waiting for fear to peak. At the same time, crypto-related stocks told another part of the story. Shares of major crypto exchanges are down more than 55% from their highs, reflecting a massive pullback from retail traders. Fewer people are trading. Volumes are thinner. Hype has faded. And historically, that's exactly when markets start laying foundations instead of topping out. When everyone is excited, risk is highest. When participation dries up, long-term players start paying attention. Institutional investors never move loudly during panic. They move quietly. According to market analysts, institutional flows into crypto have continued even as prices fell, masking how deep the retail pain really was. Some experts are now saying that what felt like the middle of a brutal crypto winter may actually be closer to its later stages, not because prices are pumping, but because behavior is changing. Leverage is getting wiped out, weak hands are leaving, and narratives are shifting from quick profits to long-term positioning. This is what real market resets look like. They aren't clean. They aren't optimistic. They don't feel like opportunity when you're inside them. They feel uncomfortable, exhausting, and emotionally draining. That's why most people miss them. The crypto market has always been designed to transfer money from impatience to patience, from emotion to discipline, from people who chase candles to people who wait for fear. Bitcoin holding key technical levels right now matters more than any influencer tweet or hype headline. These levels represent psychology, not just price. They show where buyers are willing to defend, where sellers are losing momentum, and where the market decides whether fear continues or stabilizes. Every hour Bitcoin holds, confidence rebuilds slightly. Every bounce from support sends a quiet message that sellers may be running out of strength. None of this means the pain is over. Volatility remains high. Sentiment is still fragile. One macro headline can flip the market in minutes. But what's different now is context. Earlier crashes happened with euphoria still alive. This one is happening when people are tired, skeptical, and disengaged. That's not how bubbles behave. That's how transitions begin. Crypto has been declared dead more times than anyone can count. Every cycle has its villains, its disasters, its scandals, and its collapses. And every time the technology, the infrastructure, and the long-term vision continue moving forward quietly while prices struggle. This moment is no different. Developers are still building. Regulations are slowly taking shape across different regions. Institutions are still experimenting, even if they're not advertising it. The market right now is stripping away fantasy and forcing reality. It's reminding everyone that leverage cuts both ways, that easy money phases don't last forever, and that conviction matters more than timing. The traders who survive this phase won't be the loudest voices on social media. They'll be the ones who learned risk management the hard way, who stopped chasing pumps, and who understood that patience is a position, Fear dominates headlines because fear gets clicks. But under the noise, data tells a more balanced story. Massive liquidations cleanse excess, oversold bounces signal demand. Institutional interest suggests long-term belief hasn't vanished. And declining retail participation historically marks late-stage downtrends, not beginnings. This is the moment where crypto stops being entertainment and starts being a test of discipline, a test of understanding, a test of whether you're here because you believe in the long-term shift this technology represents, or because you were chasing the last pump. Markets don't reward hope, they reward preparation. No one knows the exact bottom. No one rings a bell when sentiment flips. But every cycle leaves clues. And right now, the clues are written in liquidations, in fear indexes, in silent accumulation, and in the exhaustion visible across the market. This isn't the end of crypto. It's another chapter in its evolution, painful, necessary, and unforgiving. When history looks back at moments like this, it won't remember the panic tweets or the red candles. It will remember who stayed rational when emotion was loud, who respected risk when greed disappeared, and who understood that markets move in cycles, not straight lines. The crypto market is shaking out belief right now, and only the prepared will be left standing when the next move begins.